For keep or drop decisions in manufacturing, let's look at the terms that we need to know first, and then we're going to look at an example problem to help us understand how to use keep or drop to determine whether or not it's beneficial to have that line still exist, or if we just need to drop it in order to be more cost effective. So in managerial accounting, we have the decisions sometimes that we face of whether or not to keep a segment or a product, maybe it's a division, or whether we need to discontinue or drop that segment, as we call it, or that product or that division. And so when we look at these decisions that are to be made, we look at basically the relevant information. We may be given a lot of different details, dealing with this decision, but the ones that are relevant would be the ones that we need to consider when we're making that decision. So managers are often going to be using what's known as segmented reports, and we're going to look at a segmented income statement in just a moment. And that's going to show us the different segments of this particular organization and what the numbers are on their income statement so that we can analyze those numbers and determine what is the most cost-effective decision to be made. And so we're going to look at a segmented income statement, and you'll see in a moment where on this income statement we're going to break down the fixed expense into what we call direct fixed expense, and then we have some common fixed expenses. So a direct fixed expense is easily and directly traceable to that specific segment, again, whether that's a product or a division or a line, whatever it is that the company has broken it into. If it can be traced to that, that could be a direct fixed expense. Then you have some expenses that are called common fixed expenses, and these expenses are just shared by two or more of the segments of the business, and those will remain whether or not we drop a segment. So those will be the same. The common expenses will remain, but we may have some direct fixed expenses that can be eliminated, and let's look at an example to help us see how this works. So this is a segmented income statement for Frampton Furniture Company, and the products for this company are sofas, bar stools, and coffee tables. And so if you look at this income statement, we have sales minus our variable expense equals our contribution margin. And then from the contribution margin, we're breaking down those fixed expenses into the direct fixed expense and the common. So under the direct fixed expense, this company has advertising, supervisor salaries, and then depreciation. Once we subtract those direct fixed expenses from our contribution margin, that will give us our segment margin for each of these product lines that we see here. So sofas, $80,000 segment margin, bar stools, $69,500 segment margin, and then our coffee tables has a negative segment margin, which means it produces a loss, of $5,900. And then if you notice, under the segment margin, you have the common fixed expenses, and we have common fixed overhead. And so instead of allocating that to each one of the segments here, we're just going to subtract the total amount from the total segment margin for the common fixed overhead, and the same for the common selling and administrative expenses. So when we subtract those common fixed expenses from our segment margin, we have an operating income this year of $75,600. So let's say that our higher level managers have come to us, and they're asking us to analyze this data and determine whether or not we think we should drop one of the lines, or should we keep it. So they're wanting to see how we analyze that. And so the one that they're going to look at is the one with the negative segment margin, and that's going to be the coffee table line. So we see that the coffee table line has a contribution margin of $59,000, and it tells us, and I'm going to highlight this here, the relevant direct fixed expenses for this specific segment would be $14,900 of advertising and $38,000 of supervisor salaries. So in other words, if we drop this line, coffee tables, we will eliminate the advertising as well as the supervisor salaries, but this depreciation remains whether or not we keep or drop it. So the only relevant costs we're going to look at here would be advertising and selling salaries for the supervisors. So the question that's been posed to us is, which alternative is most cost effective and by how much? So let me show you how I would analyze this. So I've created this chart and I have all of the information that I need for keeping that particular segment are going to be in this column, and then all of the relevant cost would be in this column. And then the differential is going to be the difference in the two. So we need to look at our sales. If we keep this segment, which again is the coffee table segment, if we keep it, our sales are $236,000. We subtract from that the variable expenses of that line of $177,000, and so our contribution margin again is $59,000. In this analysis, we will only include the advertising expense and the cost of supervision because those would be eliminated if we eliminate that particular line. So we have $14,900 of advertising, and then we have some cost of supervision of $38,000. So when we subtract those from our contribution margin, we see that if we keep the coffee table line, we will have total benefit of $6,100. If we drop it, we don't have anything contributing to the bottom line. And so if we keep it $6,100, and the decision to be made is, do we keep or drop it? And even though it shows a negative segment margin, remember we're still keeping this depreciation no matter what. In reality, this particular line is actually contributing $6,100 to our total bottom line because we are covering most of those costs. And again, this $12,000 remains whether or not it's kept or dropped. And so in this case, we would say that we would choose to keep this line because it contributes $6,100 to our operating income.